Welcome to the APW Partners Quarterly Market Update to 31 March 2024. And joining me again today is Dr. Steve Garth, who is a consultant to our investment committee. Welcome, Steve.
Yeah, thank you, Dermot. It's great to be here.
Fantastic. So, Steve, when we think about some of the key themes that influence financial markets over the quarter, we saw equity markets continue to rally on the back of expectations that central banks would start cutting interest rates, perhaps towards the end of this calendar year. And this was well supported by quite resilient economic growth, it must be said, particularly in North America, continued falling rates of inflation, and also a renewed sense of optimism around the prospects of artificial intelligence and the productivity gains that may come from that. And so against that backdrop, how did the Australian equity market perform over the quarter and year?
Yeah, great introduction, Dermot. There was a certain expectation that markets would pull back from the end of last year. You might remember the last couple of weeks of last year was a phenomenal rally. And they haven't pulled back. It's been amazing. They've kept going. It's been a really strong quarter. Let's have a look at the Australian market here. You can see it's up 5.3% in the quarter and a really great 14.4% over the last 12 months. So very strong returns in the market.
And what's driving that, Steve? Obviously our market is very concentrated in banks and miners, and there can be a disparity between those two sectors which make up over 50% of our market through time. How did those sectors play out?
That is absolutely what we're seeing this quarter, this big disparity between the two markets. Financials, they're off on a tear. They're up, you can see here, up by more than 12% for the quarter. On the other hand, the miners or the resource sector, that's down by negative 6%. And that's how you get the overall 5.3%. Without the resources falling down, it would have been this absolutely crushing run for the ASX. So why are the resources down? It's really got to do with iron ore. It's fallen by 20% in the quarter, and nickel is also down. Now, this has got a lot to do with China, and China's economy is still in the doldrums. They're our biggest importer of iron ore, and they use it in their property development section, and that's been in the doldrums for a little while. So without China buying the iron ore, that price has fallen and it's pulled down the resource sector.
Yeah, very interesting. And when we look to global developed markets away from the domestic market, we know that there's a lot of developed markets that reached all-time highs during the quarter, particularly in March. Most notably, Japan reached its all-time high, last seen in December of 1989, which was quite extraordinary. The likes of France and Germany and the US and here in Australia reached all-time highs as well. So what's driving that continued positive momentum in prices, Steve?
Yeah, it's really got to do with what you said in the introduction, Dermot, is that interest rates have stopped going up. There's an expectation that they'll be coming down later this year or early next year. Unemployment remains low. We've avoided a recession. So markets have now priced in what they call a soft landing, so continual growth. So it's sort of all blue skies ahead. And as you mentioned, markets around the world, including Australia, are hitting their all-time peaks. When you look at the developed markets here, you can see really strong returns for the quarter. You mentioned in the introduction that AI is still driving that. That is still true, but not as much as last year. We're now seeing this a much more broad-based rally. So other stocks beside the tech stocks in the US are doing as well as the tech stocks. And as you mentioned too, you just look at the chart here, Europe and Japan are both contributing. So it's a very broad-based rally. Really speaks to the power of diversified portfolios. We don't know which markets will do well at which times, but when you've got a diversified portfolio, you're really capturing all those returns.
Yeah, and to that end, in our client portfolios, we've got somewhere in the order of 48 different countries across developed and emerging. And there's about 10,500 securities that make up our portfolio. So there is enormous diversification to try and capture those returns wherever they might be delivered through time. So when we look at emerging markets, we know there's, again, another disparity there with China versus some of the other countries. And obviously China represents over a quarter of all emerging markets. How has that played out by way of return? Yeah,
it looks like the emerging markets aren't doing as well. But in fact, if you take out China, the emerging markets are also booming on semiconductor, particularly in Taiwan, Korea, but even the Indian market's booming.
Up 40%, I think, the Indian market
was. It's huge. It's huge. So it's really just China, which, as you mentioned, makes up more than 25% of that index, which is really dragging down that index. So China's the laggard. It, of course, will recover and get moving again. But certainly over the last year, oh, China's down negative 14%. Of all major markets, that's the big one that's got a big negative.
Very good. Well, thanks, Steve, for sharing those insights. And thank you to all who joined us today. Have a wonderful week, and we look forward to seeing you again next quarter. Bye for now.
Bye-bye.